it, let's dive in and talk about housing. So, never a dull moment. I am, yes, the chief economist of Zillow, which means I spend a lot of my time playing with Zillow's data set, one of the sexiest data sets that covers housing in the world. But we do it in a bit of a different way too. At Zillow, my audience is a customer, in that, a real person, right? A buyer, a seller, or a housing professional who then goes on to support this real person. So, other economists tend to talk to other researchers or big, finance guys. I'm going to do my best over the course of this presentation to address agents' questions, because the agent then turns around and supports that customer. And housing markets are crazy. I don't think there's ever been a dull moment for the past, 3 decades, right? In housing, it's been a wonderful and vibrant industry to navigate and explore and fix and everything. But the last 3 years have been a doozy. Right. So we're going to start with the first big question that I think leads a lot of the conversations right now, which is, when will housing markets be normal? and frankly, how do I explain this unexplainable housing market to my clients? Right. So first, let's anchor on, what do we even mean by normal, right? When will housing markets normalize? I think what a lot of buyers and sellers, because a seller is so frequently often also a buyer, right? Well, a lot of what they're teeing on when they say the world is not normal is reflected by this slide. Here we're looking at mortgage rates bumping up and down. Over the course of the pandemic, they went for 2 years below 3%, right? And then in 2022, it was the year of change to go from 3% all the way to 7%. 2023 has been the year of up, down, up, down, up, down in mortgage rates. Most recently, we experienced a huge increase of rates. And then you see here at the end of this graph, relief, right? Towards the end, mortgage rates have come back down to 7%, still high, but up. So the unexplainable over the full course of this swing up to 8%, and then, now back down to 7%, the consumer, that buyer or seller, has probably heard from experts, me included, that mortgage rates were expected to trend down, over 2023. And yet here they go, they, swing back up. The reality in this kind of situation is that the macro economy is still playing out. And while the Fed is still figuring out how to bring inflation down, mortgage rates will likely continue to bump around. It's going to be a bumpy road. But hopefully we can anticipate lower rates in the future. By the way, our formal forecast that we have at Zillow is that rates will come down below 7% by the end of 2024. You'll notice that they're already kind of close to 7% already, though, which either means we expect much slower recovery moving forward or expect more volatility to come. Now, more unexplainable is, despite the fact that mortgage rates did that, home values didn't really fall. Now, I'm looking at this graph ahead. I want to point out a few things. This is home values. This is Zillow's home value index. It captures the typical value of a home across the U.S. using our Zestimates. It's one of my favorite things that we produce at Zillow. You see that level in gold, right? You can see the year-over-year change in that pink magenta. You can see we hit a crescendo of home value appreciation. There was almost 20% year-over-year growth in the first 2 years of that pandemic. But once mortgage rates went up, we saw a big slowdown. It was only 6 months, though, that home value appreciation nationally went negative. Just 6 months, okay? And they didn't go, and then from that moment, we saw that recovery, right? Home value appreciation started to build up again. We'll explain that in a hot second, right? It's all about the seller pulling back, and that allowed, that recovery too. But look on the most recent trend there. The more recent trend is that home values are slowing down again. That's because mortgage rates are still elevated above 7%, but some good news, more new listings that we'll see moving forward. Now, that's the national story, but it was shared across the country. And yes, housing is absolutely local. And there's a big difference from market to market, which is still very interesting, I think, particularly to your first-time home buyer, just trying to make it on the next stage. But the volatility we experienced over the course of the pandemic, there is so much that's shared. Let's start on the West Coast in LA. Honestly, this has long been a bubblier market than most markets in LA. You can see a lot more up down than the next two examples I'll show you. Though, remains to be pointed out, home values are up 37% from pre-pandemic. They're up 4% year over year, but look over the path that home values have taken as far as a falling and then recovery. Current path in LA, by the way, is one of the places that we continue to see home value growth. Let's move further on into the inland into Denver. Here you've got a market like Denver, which didn't experience a bubble last time, but certainly experienced a lot of heat over the course of the pandemic. This is a market that's experiencing over these several years, more than a decade, increasing amount of tech industries, say. Tech job growth right now is among some of the softer, so you don't see the same kind of rebound in price. You saw price correction from that pandemic heat and much slower home value growth moving forward, as possibly the employment in that area is less able to keep bidding up on prices. Now, Atlanta, let's go all the way to the East Coast and drop down south. And Atlanta is one of the fastest growing markets in terms of the number of inbound populations. So you can see here, remember those last couple of examples, LA was up 37%, the nation is up 40% since pre-pandemic. In Atlanta, you're looking at 52.6% up since pre-pandemic, still a lot of growth. And you can see a slowdown, or you might be able to see that slowdown a little bit at that end there. But on net, home values are still higher than last year. That shared experience across the US has a lot of people thinking to themselves, right, how to talk about pricing if that's what's going on, right? That up, down, everything's changing. Now, as agents, when you work with that buyer, they're going to not just interact with, news headlines that we just covered. Those home price indices really drive news headlines. They're not even just going to interact, of course, with the Zestimate, which I've spent a career explaining Zestimates to agents and how it's not the price or the appraisal, right? But a Zestimate. They're also going to experience those list prices. When we create data, and by we, I mean Zillow or other scientists or economists, I like to explain that data can do a few things. It can validate our experience. You can look at what happened last year. It can update our expectations, and it can help us form our strategy for how to move forward, right? So let's see how that might work at a situation that's a bit more, I wanted to say the word intimate came to mind, but that's not quite what I mean. Personal, a bit more personal, right? So here I've got, we're not talking about the headline, right? We're talking about the list prices that someone might see in front of them. Now, you as the expert will inform on individual list prices, but this is, using this kind of data is an opportunity to explain how important it could be to stay on top of market rate trends, something that you, as someone listening at this moment, do, right? All right, well, let's jump in. When I said it could validate our experiences, check out a couple of things. So here I want to first point out what we're looking at. This is the share of homes that sell above list price. Check out that green line at the bottom, okay? Normally, pre-pandemic, it wasn't very common for a home to sell above that list price, right? Y'all are thinking about the list price in terms of what is it likely to sell for in the market, and then added on top of that, there's an element of strategy, right? Okay, but normally in October, pre-pandemic, 1 out of 5 homes, right, would sell above that list price. So on average, you could advise someone when the list prices that you see will probably end up bidding below. Now, as someone who actively participated in the housing market, and a buyer might have heard from, say, a friend that bought last year or during, 2022, right? Or over the course of different times. So 2022, early on in this stage, lots of folks were rushing in while mortgage rates remained low. This was some of the hottest moments that we had in the housing market. A majority of homes ended up selling above that list price because of that surprising demand. Agents who were likely to stay on top of those trends would likely to have better informed their buyers strategically. But check it out. I think this is even more empowering as your value prop. Check out what's happening this year. So 2023, I still have more homes selling above list than, say, a normal market pre-pandemic. Things are still a little bit more competitive than they had been, right? But it's nothing like it maybe was when rates were below 3 and, a lot of homes were still selling above that list price, and there was a lot of energy behind demand in that market. In other words, evaluating that list price is nuanced again and requires an active agent with market expertise or someone with access to, say, this kind of training to follow what's happening in the markets in real live time. Now, we can also come at this perspective maybe from a seller. This is a very similar metric. It's another way that we can talk about pricing. We have Zillow's home value index. We've got the share of homes that sell above the list price. This is the share of listings with a price cut. This is, I think, a really interesting data point, not only because it's some of our best metrics for forecasting our Zillow home value index, right? Because this is y'all changing your pricing behavior as you watch the market slow down, right? As you watch those things change. So this is a good way for us to forecast, but how might I use it to talk to a seller about how important it is to stay on top of market data, or rather market trends, whether it's active experience in markets or whether or not it's following things like this. So let's help us interpret. Let's, evaluate, those past, experiences, validate those past experiences. The share of listings that had a price cut when we were in the pandemic and rates were below 3, very few homes got a price cut, right? It was very competitive. Today, it's nuanced again, right? I want to point out a few things. When rates were transitioning, they went from 3 to 7, we saw lots of price cuts. A lot of you guys had to revise your strategy. The buyer could no longer afford prices where they were, right? And so we ended up dropping some of what we assumed, that list could do. Now, then we stayed at rates around 6.5% for a while. So if I look at this purple line, 2023, earlier in the year, we had actually returned to more normal kind of pricing behavior, right? But then check it out. Rates went back above 7%. So what happened? Markets slowed down surprisingly. Agents responded and dropped more prices on those listings. And actually, normally, if we head into November, we see many fewer price cuts because you've already handled that, right, earlier into the season. But when price cuts remaining above 7%, there's still an incentive. A lot of sellers, in order to move those homes on, to drop the price and affect that sale right before the end of the season.
Skylar, really quick on this one.
Yeah.
Because you're talking to a whole bunch of real estate agents here, and I think this is important for us to look at and go to our current listings, our sellers, and say, hey, look, you see this is traditional. You see how the graph goes up and then comes down? We may need to cut the price, right, of the home. And I think the data you're showing, we need to start looking at all of these different aspects of it and sharing it with our clients as small tidbits. So I love this, by the way. So thank you, Skylar.
Yes. And at the end of this talk, I'll show you a QR code that you can scan that has this graph. Honestly, I've made it more cute over time. So I will go back to the dashboard and make it as cute as this one kind of looks, and we'll keep iterating that dashboard. But that's exactly it. And I have a lot of experience with agents coming up to me after I give a keynote like this, and they talk about how they would drop the price, but it's the seller that has a really hard time accepting that, right? So data like this can also help you talk to your seller that just maybe needs a little bit more encouragement to understand what's changing, right? In order to you to have a successful partnership in this sale. Absolutely. Yeah. Now, this is another kind of data point that can help us talk about that slower and yet still not quite slow enough, right? So in a similar storyline, here we're looking at days to pending. I want to point out a few things though. This is the days to pending of successful listings. In other words, this is how long did it take homes that went pending in November to do so, right? From when they were originally listed. What I'm noticing here is a similar story to what we just talked about, where homes are selling still faster than they did pre-pandemic by almost 2 weeks at this time, right? So it's still a more competitive housing market that needs more support than pre-pandemic from an agent, from that human in your corner. But it's not as bad as it was, say, during the height of the pandemic when you only had 10 or 11 days to make that decision and figure out your bid. Now, to point out some similarity too, last November was the last time that mortgage rates were at 7%. And here we have a days on market that's returning as mortgage rates are at a similar kind of high elevated level, right? It's slowing us down. In other words, higher rates have silver linings, right? In that it gives the buyer a bit more of a bargaining power, right? In order, not just because of those price cuts, right? Because they have a little bit more time as well to figure out what to do. But on the flip side, you can imagine how you might customize that for sellers as well. When we think about how to change our strategies. Okay, so that's active market. How do I help this person in front of me? All right. We also want to know where we're going. We want to know, I think, as housing professionals, that volumes will return, that inventory will return, that markets will be healthy and normal, and that we'll be able to offer our sellers and our buyers more confidence when they participate in housing markets, because the last 3 years have been wild. So, when will this inventory return and take kind of this volatility kind of out of this market if we just have more homes coming on to the market? Now, I've got good news. I really do. And I love that this is actually some of my favorite things that are happening over the last 3 months is a return of new listings. Now, over the last 3 months, so, what happens in a normal season, what we can see here, what I'm looking at is the number of homes that an existing owner will give to the market, right, in any given month. And you can see that seasonality. You can see that new listings really start picking up with, alacrity and in March, right? And then stay a high level of new listings over that home shopping season. It falls into the fall, right? Into autumn and winter. Fewer new homes are listed generally at that time. Pre-pandemic, normal is in gray. Ever since mortgage rates went up to 6.5%, and the longer that they stay there, the more the existing homeowner was locked in. Majority of mortgaged owners have rates between 3 and 4%. So when rates were up at 6.5%, a lot of owners didn't really want to give up on that affordability boon to move. For a while, so this period of time before August, we had 30% fewer new listings hitting the market than would have done normally pre-pandemic. That's a big pullback. That's big interest rate lock-in of existing owners. Then something weird happened. Weird, not weird. Mortgage rates went up to 7.5%. And new listings started to improve. Okay, it's weird on the surface because sellers get more locked in, and yet we see more sellers return to the market. New listings is now only 14% below pre-pandemic. For the past 2 months, it's been much closer to, say, 20% down than 30% down. It's an improvement. It feels great. Right? Okay, but why? Well, when you have mortgage rates go from 6.5% to 7%, the seller isn't necessarily, all that much more locked in because the bulk have lower, except for if you already had a bit of a higher rate. And then you think to yourself, no point waiting. Look at what rates are going to do. The experts like Skylar said they'd fall, and they went up to 7.5%. This is a hard situation to predict. It is often a seller or a buyer's expectation right now that rates will come back down to 5. That's changing as we see rates stay above 7, or we saw them get close to 8. what a buyer or a seller needs to participate in the market is now changing. They don't need rates to come down to 5 to move forward. Now only 6, right? Someone who was waiting for 6 might just be waiting for 7, right? Time will heal a lot of this expectation, though this recovery is faster than I expected, honestly, and it is allowing inventory to improve. And that's good because we need it, right? We need more listings because we have massive generations of buyers coming online. The bulk of the millennial generation is in green here. The median age of moving out from your parents' homes is 26 now. It's older than it used to be. And the median age of that first-time home buyer is 36. It's older than it used to be. But what that means, right, is that the bulk of the millennial generation is moving through their first-time home buyer ages. They are coming for your homes. And the boomers aren't quite ready to get rid of them yet, right? Boomers, you see that generation nearing ages where they are downsizing, right? Where they would be likely to retire. They could potentially be losing a partner and seeking to move on to rental units instead of buying that next home, right? That will come, but that generally volume is expected, much more slowly over time. But in terms of different metropolitan areas of the country, sometimes that's interesting, right? Okay, so where might I expect new listings to come forward? I mean, new listings could be coming from more retirees. That generation is very large and moving towards that perspective. What you're seeing on this graph here, it's similar to that bar chart in that most recent November. How far are we from that pre-pandemic normal of new listings, existing owner activity? Everything on here is negative, right? So we are below normal rates of new listings. That's the whole point. We're waiting for these new listings to come back. So what we're looking at here, what we want to try and notice is where are we less locked in? I'll point out that in Florida, where we have higher levels of retirees, we appear a bit less locked in. We also appear a bit less locked in Texas, where we've had a lot of recent movers who might have accepted more, say, a rate in 5, and yet they're a younger mover, a first-time buyer that moves a lot during that period of time. And then, of course, in the Midwest, where affordability could potentially be keeping housing markets lubricated, and we have new listings still recovering a bit faster there. Now, I will mention that the other way that I expect new listings to return is because of potential, softness in economies, unemployment, things like that. Let's move us to a bit more, nearer term, year over year. So where are things kind of bubbling up? I think some of this is, again, where I just mentioned, you see it echoed here. So instead of what we're looking at now, new listings, instead of since, relative to normal pre-pandemic, now it's just where has it improved over the last year. So now I have more positive numbers, pulling forward. Same story pulls forward. You see that Texas there, that's nice. You see that Midwest, that's there, that's nice. But now I have tech markets start showing up. I mentioned earlier that tech employment is particularly soft, and we've seen job loss in that sector over the last several months. And that's where we tend to see, maybe, some, we still see really tightening up in those new listings. I'm hoping to possibly see some lubrication coming moving forward there. Okay, this is a big question that we're watching. Like, when will inventory and new listings return? I think it's a really, really important part of the market because we are starting to see some of it return. However, it is softening prices. So our home price forecast is softer for 2 reasons. One, it does have those new listings built into it. So that momentum that's coming from kind of some soft, increasing to inventory and new listings returning, that supply is lovely. Taking that pressure off prices, I will absolutely take. This forecast is also soft because our forecast for mortgage rates, has us above 7%. Above 7% is tough on the buyer. So here we have a year over year, 2024, prices in housing markets to be flat. Now, that's going to bring me to one last question. And this is a question that's hard right now, because if I just told you that, housing forecasts are expected to be soft, and that's nationally that they're flat. In the Midwest, we expect, it's a little bit still positive, right? Still positive home price appreciation. Honestly, in Southern California, there's other more negative forecasts in some places. How can you talk about the value of home ownership when rates are high and home value forecasts are soft, right? And it is harder. So let's tackle it, right? Because I think in general, when you face something, I think we can build our confidence in our next steps as individuals, because I think we have to also just think about what that consumer, the decision that they're making in front of them. Okay. So if we're going to talk about the value of home ownership, I want to first acknowledge out the bat that generally, if you're talking about should you buy a home, it's going to be different for different people, but there's this earlier question that often comes down to, can I buy a home? And I do want to acknowledge that when mortgage rates are higher, I might want to save up for a larger down payment to lower my debt load to be better able to qualify and move forward. Even at a 10% down, saving for that down payment is harder than it used to be. And just by nature of this home purchase, right? This is a larger upfront financial commitment. I don't call this 80 grand here the cost, upfront cost of buying a home, because a lot of this is your down payment that you keep, but it is a large upfront barrier, right, to entering into this for sale system. Okay, so let's set aside the folks that cannot yet pursue this upfront commitment and now talk about the person who is ready to move forward, and let's address whether or not they want to. Okay, now I'm going to show you a hard graph next. This is a hard one, but it is what it is, and let's talk about it. Okay, so pre-pandemic, when mortgage rates were at around 3%, or early pandemic when they were even below 3%, and pre-pandemic when prices and rents were as they were, a new homeowner who locked in a rate then and prices then would expect to probably save $400 relative to renting the same quality unit, which is generally a rent higher than your typical renter, right? Because it's more likely to be a single family home and higher quality. So that's the rent I'm trying to reflect here. A new homeowner would save $400 pre-pandemic on a monthly basis. Today, it is what it is. A new homeowner at higher rates and at today's prices would actually expect to lose relative to a new renter, right? And that loss, difference on a monthly basis is, say, roughly around $200, right? Now, this picture is actively changing as mortgage rates come down again. In fact, they only have to come down to 6.4% for these to come back in line, and that's well within our forecast over the next 2 years for mortgage rates. Okay, so these will come back in line again. This is also why home values are forecasted to be soft, right? There's less of an incentive to move forward with prices are high and mortgages are high. You get it. Okay, but I can't stop here with this question, because the rent versus buy decision does not just solve for me my mortgage payment in the first month. And actually, when I bought a home, I didn't just secure shelter, right? I secured a long-run investment. And I likely did it using an invention, because that's what a mortgage is. It is a financial invention. And it was an invention with the following features, right? One, it gave you access to fixed payments. Right? It's basically ensuring the fact that, you'll have, what your payment will be over time. It's a hedge, in other words, against rental inflation, that rent growth over time. And we do expect rent growth to return. Leverage, you only had 20% down, but you got appreciation on the full value of the asset. Only very affluent people do leveraged investments in stocks. It would be too risky to do it. And yet the average American household can do it in real estate because it is federally insured, right? It's an element of forced savings. The longer you pay that mortgage, a share of your payment actually pays down your principal, right? If as a renter, I'm going to show you, an assumption for like the rent versus buy in a second. And I have to assume in that case that the renter is religiously saving the difference in costs, right? Or even saved that full down payment or transaction cost that they otherwise spent instead of lifestyle creep. Mortgages at least enforce that for you. And finally, tax benefits. Right? The US has big advantages. A married couple can deduct $500,000 on their capital gains, right, at the time of sale on that primary home. All of those things all flow in so that this is still a solid, long-run financial investment. Often in the same way that we've talked about housing for years, right? The average American owner has owned their home for 13 years. And yes, that includes older Americans. Over the course of the pandemic, when home value growth was extraordinary and mortgage rates were so very low, it was real that I could break even relative to renting, especially if I promised the renter a guaranteed 6% risk-free rate of return on what would have been their down payment or would have been those transaction costs. You know, even guaranteeing them 6% guarantee over the course of the pandemic, you could break even like in a year, right? That's how advantageous financially locking in at that time was, which is kind of crazy if you think about it. Like a financial decision with that much upfront barrier, so hard to achieve, pays off that quickly. Buying a home is like winning the lottery. Today, the promise is what it used to be, right? Buying a home is a good long run, steady financial investment. You will break even relative to renting within 7 years. Now, when I have flat home value forecasts in the first year, the break even gets a little bit longer. It's then 10 years, right? Buying a home is more of a truly financial investment for those that know they'll stay, that are ready to make that commitment. I want to point out something, though, before I move on to an even better final point, which is the typical American household is not familiar with stocks, can maybe not guarantee that they can get at least a 6% rate of return when they go to do their investments, or the typical American suffers from lifestyle creep. If they didn't commit their money into something, right, they might just spend it instead. And in that case, buying a home has even more financial payoff over time, right? I would break even in only 5 years. Okay, now these numbers are very personal. And as we change all sorts of things in the home buying decision and calibrate it, right, we work over time to make home ownership more accessible to everyone again. But I also want to point out that say you don't stay the home for this period of time, well, what you've done, right, is that difference in that cost to become an owner, that was the cost of your ownership. That was the cost of affecting your vision. This is my vision that you're seeing here of my backyard farm and the cutest little farm hands you've ever seen, right? And if you come over to my house, you know it's my house, right? I didn't just buy my house for a financial decision. And I didn't even just buy it for shelter. I bought it for what it could be in 2 years, in 3 years, for my girls, right? And growing in that space. That's what someone shows up to you for as an agent. It's not just those financials, it's that confidence that they need to try and achieve a lifestyle they're going for. So all those strategies for how to tackle a market, combine that with your strategies of how to serve this individual person in front of you, right? And that's how we help folks successfully navigate a housing market today and into the future. Check out that housing snapshot dashboard that I mentioned earlier. It has some of the data points that we talked about today. I will continue to improve that over time to make it even, easier to use. Hopefully, please give feedback. I love feedback about what would help you interact with your buyers and sellers. And thank you so much for having me.